Good morning, everyone. Today is Thursday, November 4th, and I'm bringing you this video because we're going to be talking about a very important subject. Now, I'm recording pretty early in the morning. Hopefully, I can edit and get it all out. This video is going to be short, it's going to be brief, but it's going to be an update on what's happening with interest rates. What the heck is going on with interest rates? Now, if you don't know exactly what interest rates are or how they affect the broader economy, I suggest watching a short YouTube video. Just type into YouTube The Economic Machine by Ray Dalio. Ray Dalio is a very successful hedge fund manager. But anyway, the video is really cool to watch, very easy to comprehend and understand. Sometimes the economy can just feel like wow, I'm way over my head. The more I learn, the less I know. And seriously, it's true with these economic principles. But today, we're going to be talking about one of the foundational pillars of the United States economy, and that would be credit. Hi, everyone. I'm Bruce Bradbury, and I live in Bellevue, Washington. I'm actually a full-time real estate broker. And as the YouTube bio, the channel bio suggests, I love filmmaking and I love spreadsheets. So I just kind of want to combine that up and create content that's compelling and also talk about this important subject, which would be interest rates. Bellevue is a very unique environment, okay? We have a lot of big tech companies here. Amazon was founded in Bellevue. We have Microsoft headquartered in Redmond, Costco, Starbucks. Those are just a few. Because of all these tech jobs, these high-paying tech jobs, Seattle has had a persistently hotter market than the national average. We've actually been top 10 hottest market, I think, for a few years now, okay? So it's a bit of a unique situation here. Everything that's happening on a national level, in my opinion, seems to be amplified here in Washington. Now, there are two foundational pillars, really, to this whole economic machine. To make it really simple, there's money and then there's credit. Money, think of as cold, hard cash. Credit, think of as a mortgage loan or another loan. It's a promise to repay money back in the future. And what's very important with credit is that it allows economies to work at scale and at speed. For every dollar in the economy, there's essentially about $20 of credit. So money only counts for about 5% of the money in the economy. The rest is credit. And that's where interest rates come in, because interest rates support the flow of credit in the country. Today, 4 things I'm going to run down in this video. Okay, first, we're going to be talking about the Federal Reserve press conference from yesterday, November 3rd, where Jerome Powell spoke about the economic plan for the future from the Federal Reserve. And the Federal Reserve is the central bank. So basically, they control interest rates. They also control bond purchasing. Those are the two basically powers, superpowers of the Federal Reserve. Next, we're going to be talking about inflation concerns in the economy. Of course, with the pandemic that occurred last year, there was a ton of new money printed into the economy. And so what happens when we have a surplus of money printed into the economy? Well, the first guess is that there's going to be an increase in spending. There's going to be an increase in inflation because there are more dollars chasing the same amount of products. Essentially, that's kind of a smooth breakdown of how inflation would work, but it's, might not be as simple as that. Third, we're going to be talking about the Federal Reserve's plans to begin tapering bond purchases. Now, by tapering, they mean slow down. The Federal Reserve every month is purchasing a ton of bonds. The first Federal Reserve superpower is to control interest rates, those levels of federal interest. Now, during the pandemic, the Federal Reserve dropped them all the way down to 0 to stimulate the economy. That's why we see mortgage rates and everything falling and basically creating this hype to get a loan because financing and money as a whole is so cheap. The second superpower of the Fed is this complex process of purchasing bonds from the market. This is basically what stimulates the bond market in the US and then furthering stimulating the stock market. As of late, in the past year, because of the pandemic, the Federal Reserve has been purchasing about $120 billion worth of bonds per month. Okay, fourth, we're going to be talking about how this affects real estate prices, particularly pertaining to mortgage interest rates. Okay, here we're going to watch a little bit of a press conference that happened yesterday from Jerome Powell, the chairman of the Fed. You know, J. Powell, the money man himself, J. Powell. I love Jerome Powell. He's such a cool guy. He's the chairman of the Fed, and we're going to listen to him speak real quick.
We are committed to our longer run goal of 2% inflation and to having longer term inflation expectations well anchored at this goal. If we were to see signs that the path of inflation, or longer term inflation expectations, was moving materially and persistently beyond levels consistent with our goal, we would use our tools to preserve price stability. We will be watching carefully to see whether the economy is evolving in line with expectations.
Okay, essentially that little bit talking about the inflation rate. Normally, a stable United States will have about a 2% inflation rate per year. And I kind of have this, this chart. So if we go back 10-year, or even 25-year, no, let's stick with 10-year. So if we go back to 10-year, we see all the way from 2012 to 2020, before the pandemic, interest rates stayed around 2%. However, in 2021, right when the pandemic ended, I presume, people got out of their houses and started spending all that stimmy money. When the pandemic ends, of course, we want to go out and we want to spend it. So that's kind of my theory behind this increase right here, this dramatic. So let's look at the 1 year. Okay, we're in March 2021, and then whoa, in April 2021, things started opening back up. The economy started lifting itself and started working and moving again. We see, whoa, a 4% interest rate year over year. And then in May, 5%, 5.4, 5.4, 5.3. Okay, we're at a 5% inflation rate, which is really crazy considering that the stable is 2%. And there have been these inflation concerns in the economy because it has been real. We've seen asset prices soar through the roof. And I'm pretty sure we're looking at the consumer price index here, which doesn't include key assets like housing, real estate, stock market. That asset inflation we can expect is to be way higher because a lot of money during the pandemic flowed into the stock market. And that's why the stock market has been going crazy the past year. Okay, so there have been some major inflation concerns within the economy, and that's basically what Jerome Powell is addressing there. Next, we're going to be looking at a clip a little bit later on in the press conference talking about the taper. Remember, the Federal Reserve has been purchasing about $120 billion in bonds per month.
But certainly we should see inflation moving down by the second or third quarter. The time for lifting rates and beginning to remove accommodation will depend on the path of the economy. We think we can be patient. If a response is called for, we will not hesitate. So, supply functioning and accommodative financial can be judged that the economy has met this test and decided to begin reducing the pace of its asset purchases. Beginning later this month, we will reduce the monthly pace of our net asset purchases by $10 billion for Treasury securities and $5 billion for agency mortgage-backed securities. We also announced another reduction of this size in the monthly purchase pace starting in mid-December, since that month's purchase.
Okay, so that's basically the big news there. The Fed is going to, every month, taper their bond purchases by $10 billion in the markets and $5 billion in the mortgage-backed securities, total of $15 billion. So in December, we can consider the bond purchases will be 105. In January, we'll consider the bond purchases to be 90. In February, we'll consider the bond purchases to be 75, and so on, until the Federal Reserve is not purchasing bonds any longer. Okay, I found this article from Fortune with an informative paragraph. Once the Fed has ended its bond purchases by mid-2022, it will then turn to a more difficult decision: when to raise its benchmark short-term rate from 0, where it's been since COVID-19 hammered the economy in March 2020. Raising that rate, which affects many consumers and business loans, would be intended to make sure inflation doesn't get out of control, but it would carry the risk of discouraging spending and undercutting the job market and the economy before they've regained full health. So particularly interest rates affect real estate prices. Next, we have a 30-year fixed mortgage averages for the United States. We just read in the previous that the mortgage rates were dropped to 0 on a federal level. And think of that as the foundation. The foundation for which everything else, loans and financing and interest, are built upon. So if you have a car loan for, say, 6.9% or a mortgage loan for 3%, okay, that is the top level of this financing. First, you have the Fed's interest rate, and then you have the vendor's interest rate on top of that. So when the Fed lowers their federal money interest rate, then it lowers everything else. So essentially, loans across the board become cheaper to purchase. So let's look back 2000, okay? Interest rates of 8%, 6%, 5%. Over this period, we've seen interest rates just decline. But until 2020, interest rates really declined. I mean, you could get a mortgage for 2.6%. Some people can still get mortgages for 2.85, 2.9%, which is crazy. I mean, basically, my reasoning is that if the interest rate is below inflation, it's basically free money, okay? The inflation is going to eat away at that mortgage interest that you're paying, and essentially you're getting a free loan. That's how I like to look at it. So let's zoom in a little bit here just to 2020, and we're at 2021. This was really the bottom, and then we see them, go up a little bit, but the federal interest rate is still at 0. So that's the importance of this whole video here, okay? Once the Fed ends purchasing bonds, once they end the taper and they're no longer purchasing bonds from the markets, then they've exacerbated one tool from the tool belt to help stimulate the economy. Remember, they have two superpowers. One is bond purchases, and the second is interest rates. They've already lowered interest rates down to 0. So the big question on everyone's minds is, when the Fed does finish the tapering, okay, then what are they going to do to help control inflation if it does become a problem? They're going to raise interest rates, of course, because they've already exacerbated that first tool. So the second tool is increasing interest rates. And generally, there's a rule of thumb in real estate prices when interest rates are increased. Okay, we can think of this as interest rates are increased by 1%, real estate prices are reflected by going down 10%. 1% up with the interest rates, 10% down with the real estate prices. And putting myself in the shoes of a home buyer, okay? The price of the home doesn't necessarily matter. No, I have an income, and the loan payment is essentially how much home I can afford, okay? So within that home payment, you have the principal, you have the interest. So as interest rates increase, then more of that monthly payment is going towards interest. Thus, my principal pay down, or how much I can afford for the house, is going down. So as interest rates increase, my purchasing power or my ability to afford goes down. The less home I can afford, and vice versa. So the big question, the big reality of this whole video is talking about what's going to happen in Q3 and Q4 of 2020 if interest rates are increased. Or should I say when interest rates are increased, because we know that they can't stay at 0 forever, because that's a very dangerous thing if it persists. Okay, putting myself in the shoes of the buyer again, I'm going to consider what do I want? Do I want low prices or do I want low interest rates? Because I can't necessarily get the best of both worlds. Okay, normally when we see down pressure on real estate prices, it is because of interest rates are higher. And that's why we're seeing in that graph we saw earlier where when interest rates were, if you were to buy a home a few years ago, the interest rate was 6%. Okay, and then in the pandemic, interest rates fell to 2%. And a lot of people refinanced their homes. That means paying off their current loan with a new loan at a lesser interest rate. So basically a lot more money in the homeowner's pockets, okay? Purchasing at a low interest rate isn't necessarily required, okay? It's something that we become accustomed to in this market, but remember, these are kind of historic low interest rates. So my question is, just at the end of Q3, Q4 2020, what is going to be the situation with the housing market? And one thing, to put myself in the shoes of a home buyer, I have to consider, if I'm waiting for home prices to fall, but I don't want interest rates to increase, I kind of have to think about the whole terms of the pricing situation. So here in Bellevue, for instance, the year-over-year price increase is about 14%, which is insane to think. And I'm just asking, of course I don't have all the answers. I don't think anyone does when we're dealing with the scale of the economy, is will real estate prices continue to increase? And then in Q3, when interest rates inevitably go up, how far is the market going to fall? And we can use that rule of thumb. But consider, if I'm considering, should I buy now? Should I wait? It's something to consider, to do some puzzle solving problems, to see where prices are going to be. In my opinion, I think it's always better to be in the real estate market. And not just the real estate market, it's important to be in the market in general, instead of out of the market. Because when you're in the market, you're exposed to the potential upflows of the economic system, essentially. That's how I like to look at it. So whenever I'm putting $1 into the S&P 500 as an investment, I am exposing myself to the United States economy. And historically, the economy has always grown, okay? We are very growth-centered as a society and as a world. So stock prices generally do go up over time. And same thing with real estate. Real estate always goes up over time, over the long run. Now, you might be thinking, okay, great, we're going to be going up quite a bit in the near future. But what if the market crashes? Well, if you're a savvy investor, you don't really care about the short-term ebbs and flows, okay? You care more about the long term. The long term of holding the asset, of having the home, of just not really caring about what's going on with the price fluctuations and just living your life inside of the home that you always dreamed, it is definitely more important. And also from a financial perspective, I think is a lot more savvy to just buy and hold. So over time, historically, think over 20-year, 30-year period, that asset has to increase in value. So you do have the short-term ebbs and flows of interest rates and home prices and all of that. Over the long term, I think it's always a bullish thesis to buy and hold and own real estate. Okay, so that's it for this video. Hope I made it all make sense. Interest rates are crazy. So I hope this video came across. I hope to make more videos like this in the future. And if you like this video, just, give it a like on YouTube and everything. Let me know. Talk to me. This is an open dialogue, so let me know what you think. Share it with your friends. Okay, that's basically the whole pitch. All right. My name is Bruce Bradbury, and thank you so much for watching today. Have a good one.